All right, now to a news alert in the bond market. Two-year notes, they are up for auction. One of the final, maybe the final of the year. Rick Santelli's at the CME. Rick, Merry Christmas, Happy New Year, all that stuff. And is it going to be a Happy New Year for the bond auction?
Well, you know what? It's a very good two-year note auction compared to the last 6 years. This particular auction, 56 billion two-year notes. The yield at the Dutch auction, 0.769, so a whisker under 0.77%. But it tailed. The one-issued market was trading 0.76. The distance between where it was trading and how far back they have to push the bids and offers to fill the entire order, that's called a tail when it moves in the wrong direction. And this tailed almost a full basis point. Why am I bringing all this up? Because the last 6 years, the two-year note is notorious for leaving big tails. Much bigger than this 1 basis point tail, actually. But I still gave it a C. Took off for the tailing. There was another big bright spot, though, and I'll get to that in a minute. 2.55 is the bid to cover, higher than the 10 auction average. 61.4 indirects. This is foreign participation. That 61.4 is the highest percentage of indirect bidders going back to June of 2009. There's your highlight there. If it wasn't for the tailing, it probably would have had a better score. Tomorrow we'll have 5s, followed by 7s to complete all the supply, and none of it goes particularly well in December. So, of course, we'll keep everybody apprised, Brian. Think about it this way. The two-year note closed last year at 0.12, which means it's up almost 60 basis points for the year thus far, which makes sense because the market's looking ahead to what the Fed may do with rates in 2022.
But, Rick, here's the thing. If we did this last year at this time, and by the way, we probably did, but it felt like 5 years ago, almost anybody of the smart money set that we would have asked, where is the 10-year note going to end the year? They probably would have said 2%, above 2%, around 2%. We are under 1.5%. What did everybody get wrong? Where did all the experts, with the exception of a couple guys like Scott Minerd and Sri Kumar, where did they blow it?
Well, I'm not sure that anybody blew it. I think a better way to look at it is that logic doesn't prevail when you have central banks putting their imprint on the scale of where interest rates globally need to be. Now, this isn't a debate as to whether they did the right thing, the wrong thing, or their presence to try to combat the effects of the global economy on COVID should have been done or should not have been done. It's just a fact that many thought the yields would be higher because logic dictates they should be higher. But the risk-reward parameters get distorted when central banks, of course, keep printing, and quantitative easing means they issue debt, they buy it back, they put it in the corral, and what's the corral? The reverse repo market. Basically, at 1.6 trillion is in a parking lot waiting for some future use. And when that future use becomes more obvious to the rest of us, that's when they're going to be right, Brian, and rates will go up.